Hey, my name is Zack Ellison. Thanks for sticking around today. I do want to thank the host of this conference. This has been a very good conference. And it's great because it's a very diverse group of people. I normally speak at investment conferences, and this has some components to that, but it's also just much broader, which is nice. So today I'm going to focus on the innovative way to innovate, essentially, and the innovative way to fund innovation. And I'm going to walk a little bit because I try to get 10,000 steps a day, and I haven't gotten many steps the last couple days. So so I work for a company called Applied Real Intelligence. We are a venture debt fund, and you probably have never heard of venture debt because 95% of institutional investors have not. So why would you have heard of it, right? It's actually one of the fastest growing areas in the market. It's a great product. It solves a lot of problems for founders. It also presents a lot of solutions for investors. So I'm going to talk to you today about what venture debt is. And by the time we're done, you'll have more information than 95% of the investment market. And I'm not kidding. So a little bit about today's agenda. We're going to talk for about 20 minutes. I'm going to go over what's been happening in the public markets with stocks selling off and bonds performing poorly, and what that's meant for investors in terms of shifting their investment portfolios to alternative assets away from stocks and bonds. We'll talk about what venture debt is at a high level, and then we'll talk about the benefits for startups, why they like venture debt, how it solves problems for them. And then we'll get into how we de-risk venture debt and why the word venture actually implies less risk in this product instead of more. Typically, you think of venture equity as being risky. Well, venture debt's actually very low risk, and we'll get into why that is. Then, of course, we'll talk a little bit about performance historically, and you can see how venture debts provided great returns and low risk for investors. And last but not least, just all the benefits out there for investors. So with that, I want to talk a little bit just briefly about my background so you know who the heck I am. I've spent the last 20 years or so in the financial markets. I actually started out at Thomson Reuters, but it was Thomson back then. And I went from Thomson to Scotiabank and was a loan underwriter of telecom and media loans, and this was during the financial crisis. From there, I went back to business school at the University of Chicago to do an MBA. I came out of Chicago Booth and went to Deutsche Bank, which at the time was actually the best performing, probably the best performing fixed income shop in the world. They were the biggest bank at the time with 2.8 trillion in assets. And so I actually worked on Wall Street at 60 Wall Street and traded bonds and credit default swaps there. And I went from Deutsche Bank to Sun Life, my third Canadian company. And at Sun Life, I helped manage a $25 billion portfolio, mostly corporate bonds and other fixed income. Along the way, I also did another master's at NYU Stern in risk management and completed the CFA program and the Kaya program, which is the Chartered Alternative Investment Analyst program. I'm actually on the board now of CFA and Kaya in Los Angeles. I think I'm the only person in the country on the board of both in a major city. And last but not least, since we're in Florida, I'll mention this. I'm in the process of working on a PhD and doctorate in business at University of Florida. So if you're a Gator, go Gators. There we go. All right, excellent. So that's my background. So I've got a lot of experience in investing, specifically fixed income. And we'll talk briefly let me talk about how I came across venture debt. So essentially, this was 2018. And I was really looking for a strategy that I thought could produce excess returns. Corporate bonds were not doing that well. They had low yields. Everything that's happening now, you could foresee. If your advisor tells you they didn't see this coming, you should get a new advisor. Sorry to anybody that's an advisor who's offended by that, but it's true. So essentially, a number of my mentors came to me that were in the VC space, and they said, Zack, we've got a lot of portfolio companies that we've invested in that are now doing quite well, and they've reached a Series B or Series C or Series D financing round, and they're looking for growth capital, but they don't want to sell as much equity, and they'd like to keep that equity because they're very successful. And the last thing you want to do when you're building a successful business is sell equity. If you can keep it, why not? And the takeaway was that these founders were willing to pay what I would consider a very healthy return to borrow money because it prevented them from getting diluted out of their ownership positions. So I started looking at this asset class, and I thought, wow, these returns are amazing, especially on a risk-adjusted basis. There are returns of north of 20% in most years over the last 20 years. And in addition to that, the loss rates were about equivalent to investment-grade bonds. So imagine you've got investment-grade bond risk, but you're getting paid 5-6 times the yield. It sounds too good to be true. I thought it was, and so I had to look into it myself. And I kept thinking a bunch of skeletons were going to fall out of the closet. Right? I kept thinking, hey, the more I learn, the more I'm going to get excited about this, and then I'm going to learn it's all a hoax, right? And turns out it wasn't. And what I found was it was really the opportunity of a lifetime for me personally, and the next big growth area in funding innovation. So we're going to talk today about what venture debt is and where it's kind of positioned in the market right now. Before we get to that, I just wanted to show you these slides, which everybody kind of knows, but essentially performance this year has been terrible. Stocks are down about 25-30%. Even more surprising to many people is that investment-grade bonds are down anywhere from 20 to 35%, depending on the duration of those bonds. Longer-term bonds have fared worse because they're more interest rate sensitive. So as rates have gone up, bond prices have gone down. So essentially, you've got a whole bunch of investors that have lost anywhere from 25 to 35% of their money in their, quote, safe investment portfolios. And in the more speculative portfolios, like cryptocurrency, for instance, that's Bitcoin's down about 60% year to date. A lot of the speculative assets are going probably to zero in some cases. I hate to say that in Miami because I know this is the crypto capital of the world, but it's been a rough ride, and I think it's going to get a lot rougher. And a lot of institutional investors are now seeing that they need to get back to the basics approach. Find investments that actually have assets, find investments that have cash flow, find investments that have intrinsic value. The good times are over, and so now we've got to really think about where is there safety, but also sufficient return. So venture debt, this is where it gets interesting. Venture debt's one of the few asset classes that provides safety, access to innovation, but also really good risk-adjusted returns. So I titled this slide, Welcome to the Party, because I've been talking about venture debt for about 3.5 years now. And only recently, some of the biggest, smartest institutional investors on the planet have taken an interest. So Blackstone has announced they're going to deploy $2 billion in capital in venture debt of their own money. So this is not accessible to folks in the room yet. KKR has said, not publicly, but it's been reported in the news that they're looking to buy venture lenders or build their own in-house team. And Oaktree, which is one of the largest institutional investors in one of the bigger venture debt focused funds. So you basically got Blackstone, KKR, and Oaktree, three of the smartest and most respected shops on the planet, now saying, hey, we want to get into venture debt. So it's nice to welcome them to the party. So what is venture debt? Essentially, it's actually a very simple strategy. It's loans that are typically 3 to 4 years, and they're made to growth stage companies that are already venture backed. So these companies are typically a Series B or Series C company that's already completed that equity financing round, and they just want additional growth capital that's cheaper than equity and faster to obtain, and of course, much less dilutive. Most of these loans are made historically to tech companies because most venture capital goes to some type of tech company or company that enables efficiencies. I consider that technology. Consider venture debt a complement to equity and not a replacement. We're not coming in providing them with capital because they're doing poorly. We're coming in to give them additional growth capital because they're doing so well. You may have heard this term or slogan. Basically, when you need liquidity, it's impossible to get it. Try getting a loan, a mortgage or car loan when you've got bad credit. You'll never get it. But if you've got great credit, you already have money, you can borrow money very cheaply. And it's the same thing with venture debt. So these are not loans to struggling companies, they're loans to the best companies, essentially in the technology industry. One thing I'll mention is that the growth of the market's been quite substantial. About 10 years ago, it was 5 to 7 billion was deployed each year in venture debt. And now that's up to about 30 to 35 billion. So it's been about a 6x improvement in size over the last 10 years or so. And we project that this will probably be a $75 to $100 billion market within the next 4 to 5 years. Historically, also to put it into context, venture debt's been about 10% of the total venture equity financing each year. So for every 100 billion in VC funding, there was roughly 10 billion in venture debt. So they grow together. What's happening now, though, is that debt is actually taking a larger share of the total pie. So as venture equities boomed the last couple of years, so has venture debt. But I think as the market becomes more sophisticated and founders become more knowledgeable about how to fund their companies, you're going to see debt become a greater percentage of the total innovation funding pie. I wanted to put this slide up because a lot of people have a misconception about the word venture. They think venture and they think two people in a laptop in a garage and a dog, coming up with some ideas, burning a bunch of cash. And that's true for early stage venture. It's not true for venture debt. So typically where we come in and other venture lenders is what's called the growth or expansion stage. So this is when companies are already generating revenue. Typically about 10 million per year minimum is what we look for in revenue. Oftentimes multiples of that. So the sweet spot's kind of, call it 20 million to 100 million per year in recurring revenue. But these companies are burning a lot of cash because they're growing. So there's oftentimes still a big gap and they're what's called EBITDA negative. They're essentially cash flow they're not delivering positive cash flow or earnings because they're burning so much cash. So they might be generating $30, $40 million a year of revenue, but burning 50 or 60 to grow very quickly. So where we come in is essentially where these companies are at their peak growth point. So on this chart, it's stage 4. So essentially we just call that the growth stage. In addition to the 10 million a year of revenue, we look for the same things that equity investors would look for. Do they have a really talented management team? Do they have a lot of product market fit and traction? Is their product differentiated? Are there barriers to entry versus other products? And we want to have high conviction, of course, that all these boxes are checked. And also, typically, these companies are very technology focused. So they're not necessarily pure play software, but they're enabling efficiencies in the economy. And if they're not enabling efficiencies and it's a business that we can't understand, we just wouldn't invest in it. So this is a key slide, benefits to founders. This is ultimately what's driving growth in its entirety. You've had 700 billion in equity financings the last 2.5 years, which, to put that into context, 10 years ago, the average funding in VC was about, call it 60 billion per year. And then in the last year alone, it was 340 billion. It's just exploded. And that's because we're in a bubble. There was a lot of liquidity and people were making a lot of investments. But what that means is you've had 700 billion in fundings, and all these companies now are going to be looking for more capital as they grow. So you've got this giant swath of companies that are looking for money. And founders love debt because it's less dilutive than equity. So essentially, if you can borrow, you will. I mean, that's ultimately the rule. There's no reason to sell equity if you can get debt and not dilute yourself. The other thing that's important is, aside from the dilution, it just speeds up the pace of growth. If you've got $1 to grow, that's great, but if you have $10 to grow, it's going to happen much quicker. So we see a lot of founders essentially using venture debt to accelerate their growth, get them to their next big milestone, get them to a higher equity valuation, and then at that point they might sell some equity because they're selling it at a much higher price. A couple other things I should note. The cost of debt roughly is about half, call it 40% to 50% the cost of equity. So founders are willing to pay 15 to 20% all in for debt, but they're implicitly paying a lot more by selling equity. Typically, most VCs are looking for a return on capital of 30 to 50%, double that of debt. It's also very fast to obtain debt financing. Typically, you can get a round done in 4 weeks, 6 weeks max, where it could take a year to do that on the equity side. And in this market as well, it's also important because valuations are falling. So if you're trying to get money from a VC, there's oftentimes a valuation fight. so to speak. You're saying as the founder that your company's worth X, the VCs are trying to fund it at half of X, right? We don't necessarily need that on the lending side. We just need to know that this company is solid and will repay its loan. We don't necessarily care what the paper valuation is. And so that saves founders a lot of time and a lot of angst. There's also very flexible structures in the debt space. There's a whole bunch of ways you can structure these deals to meet founders' needs in terms of cash flow and maturity. And it's too much to go into now, but suffice it to say, there's a million levers to pull, essentially, to get people what they need. So I do want to talk briefly about how these loans work and why they're so low risk, and then we'll talk about returns and losses historically. So the big thing here that we've already kind of gone over is they're relatively short duration. Most of these loans are paid down in 2 to 2.5 years. In a bad economic cycle, they won't be paid down as early, so I expect they'll be paid down in 3 to 4 years in the market we're in now. That said, they're all floating rate loans. Typically, it's either prime or SOFR plus a credit spread, and that gets you to a debt yield when you include other fees as well of mid-teens, typically 15% historically, which we'll get into. And all of these companies are cash flowing. They've all done a equity raise prior to the debt coming in, and well, not always, but 95% of the time. So essentially, you're starting out in a low risk state. You're lending to a company that's just raised a bunch of money, that's just gone through due diligence, that's flush with cash, that's got great growth prospects ahead. And they're really just borrowing money for a couple of years. I don't need to look out 10 years and guess if this company is going to change the world. Frankly, it doesn't really matter to me. What matters is, are they going to be able to repay the loan in 2 to 3 years? And we can look out very effectively over that period. The other thing that we should mention, or that I should mention, is what really de-risks these is the loan to enterprise value. So if you think about most loans, lenders are going to make the loan looking at your cash flow and your hard assets or your collateral. What's different with these loans is that these companies are younger, so they don't have as much of a track record. They're burning cash. They don't have as many hard assets. That said, we're really lending against the enterprise value of the company. So if we think let's say the VC thinks a company's worth $200 million. We do our analysis and think it's worth 100. We might make them a $10 million loan, so we're lending 10% against the value of the company. And on average, most of the loans are less than 20% of enterprise value across the industry. And the better lenders keep this metric to between 10 and 15%. So what that means is you could take this $200 million company, do everything wrong, destroy nearly all the value. You could destroy 90% of the value, still have 20 million left in value, and your loan would still be 2 times covered. Right? So that's the starting point. You just don't over-lever the companies. The next thing we look at is how much cash they've raised in their most recent round. And we typically want to keep the loan to be less than 25% versus the cash they just raised in the equity round. So imagine you're a company and you want to raise $50 million, the cheapest way possible, most efficient for you as the founder. You might want to do 40 in equity and then do 10 in debt. The 40 in equity that you raise de-risks us as the lender, but the founder likes it because they save themselves that $10 million chunk of dilution, which ultimately could be worth many multiples of that. We're looking also at recurring revenue. So all these companies, as I mentioned earlier, are basically doing at least 10 million per year in revenue. We don't want to lend more than 50% against their top line revenue. And we've got pretty good visibility into top line revenue in most of these cases. And a lot of the companies, because they're tech focused, have sticky recurring revenue. So think about like a software program that you sign up for. You're signing up for 1, 2, or 3 years in some cases. So that revenue is sticky, it's contracted. And if you're ultimately keeping the loan to be sized right versus enterprise value versus cash versus the recurring revenue, the risk is actually very low. And then, of course, you've got a senior secured first lien on all the assets, meaning if the company does default, you get paid first as the lender before the equity holders get paid off. So it's very, very hard to lose money if you structure these deals properly using these terms that I'm outlining. The other thing I should mention is that the loans are monitored monthly, and they're actually monthly pay, meaning we're getting an interest coupon every single month, which is different from public companies where typically you see quarterly financials. We also have board observer rights, meaning we're not voting on the board, but we know exactly what's going on and we sit in all the meetings. And last but not least, if things do go wrong, you've got these equity sponsors that are very smart and well capitalized, these VC funds, to essentially help the company out of trouble. So all these factors together are what reduce the risk. Now, this is just showing the asset coverage you'd have. So if you've got the loan principal, which is in green, you'd have to destroy a lot of value on top of that before your loan's impaired. I won't really go into this because we kind of went over it already. All right, so here's where it gets interesting. We've only got about a minute and a half, but we're going to get to the punchline. So the punchline is that historically these loans have generated a 15% debt yield, and they've never had a year where they've lost money, ever, including 2009. I didn't really mention this earlier, but we oftentimes will get warrants on all these deals, meaning the option to buy stock in the company at a later date. So that also adds some return potential. And typically, historically, what we've seen is 15% debt yield, and this is how we get there. So you get 11% coupon, and then you get 2% roughly annualized in what we call success fees. That's a back-end fee. So whenever the loan is exited, they typically pay a one-time fee to the lender. And there's also other fees you clip along the way, like an upfront origination fee that you'd see in real estate as well. And also, if there's a prepayment of the loan, you oftentimes, as the lender, get paid for that. And last but not least, the equity warrants that you get are typically worth about 5% per year. So this is all backwards looking. This is real data getting you to that 20%. But now rates are up 3% since March. So all these numbers are up. So that 11% cash interest, we're seeing that closer to 14 or 15% in the market right now. And we are also getting bigger equity chunks at a lower equity valuation. So we expect that equity return to be higher as well. So all-in return in this market is closer to 25% versus the 15 to 20 that we saw historically. Last thing I'll mention, or almost last thing, because we're out of time. These are the historical loss rates of Silicon Valley Bank, which is the biggest lender in the space. And I want you to know that they're doing about 60% of the loans in the market. The last 10 years, they only lost 0.3% annualized, where they wrote off 0.3% of their book, but then they made money on the other 99.7% of their loans. In 2009, the worst year in history, they wrote off 2.64% of their book. They still made money because they were underwriting loans in the high single digits at that point. So the punchline is that you're getting this return that's roughly 20% with loss rates that are less than 25 basis points per year. And as an investor, that's very attractive. The high absolute return is attractive. Floating rate loan, very attractive. It's senior secured with a first lien on all the assets. It's got an inflation hedge because of the floating rate nature of the loan plus the warrants. Co-investing opportunities if you invest in private funds. And very low correlation to other asset classes. So when bonds and stocks are getting hurt in the market, these loans are typically not feeling that at all. And you're getting paid every month. So that's all I had. Perfect timing. The last thing I'll say is that this is an analogy I like to use that I think kind of makes sense. Think of going to a horse race and you're betting on horses. And when you're a venture equity investor, typical VC, especially early stage, you're betting on a horse before you've even seen it on the track sometimes. Or maybe it's out there and walking around. You haven't seen it run and you're placing a big bet. As a venture lender, we're making our bets when the horse has already run 80% of the race. So we're not always going to win, but we have a good idea of who's going to win, place, and show. And we could lose at times, but probability adjusted, we're going to win most of the time. So I'll leave it at that. And if you have any questions, I'd be happy to send you the material or talk to you offline about venture debt. Thank you.